Okay, good morning everyone. My name's Simon Wally. I'm the Housing Finance Programme Coordinator here at the World Bank. Welcome to this session on affordable housing finance, which, as Loic said, I think follows on very nicely from the discussions we were having in the previous session. Mahmoud Mohildin spoke about the 6 pillars which underpin a successful housing finance system. Now, one of the pillars was about, do we have the right products for housing finance? He then also spoke about the democratization of finance and the need for expanding access and having an inclusive system. I think this session focuses on exactly those issues. The 3 speakers will share their experiences, both on the products and policies used in their countries to achieve this. To start the session, we're going to have a very short video showcasing some of the work that we've been doing recently in Egypt. My colleague Sahar Nasser will present the video. Sahar is the lead financial specialist based in Cairo and also the task team leader for 2 mortgage products, 2 mortgage projects that we've worked on in Egypt over the past few years. The first speaker after her will be Kesia Rust, and this is the first of 2 speeches she'll be making. She's also taking part in the speed dating session after lunch today. Kesia is a coordinator of the Finmark Trust Centre for Affordable Housing Finance in Africa, and she also manages a secretariat for the African Union for Housing Finance. The second speaker will be David Smith, who's a veteran of our conferences. He spoke at our event 2 years ago. And he's the founder of the Affordable Housing Institute, with a tremendous amount of knowledge and experience all around the world. The last speaker is from Morocco, a country which you may have already heard mentioned in the McKinsey's presentation this morning. Morocco is really leading the way in terms of developing innovative solutions to the affordable housing challenge. The speaker is Nouamam El Hassaimi, and he's the head of the credit division at the Ministry of Economy and Finance. So we'll start off with a short video which my colleague Sahar will introduce.
Thank you very much, Simon. As I'm sure all of you are aware, one of the key demands of the Egyptians in the wake of the revolution of January 25th was equal access, a fair opportunity, dignity, as well as a transparent and competitive system. In that regard, the urgent need for a shelter, a housing for the poor, is a goal that is so much in line with promoting the kind of equity the Egyptians had rallied for at the Tahrir Square. In Egypt, approximately 75%, if not more, of the newly formed households have no access and cannot afford to acquire a house. And the only options they have is either to proceed with rental or to go to the informal sector where there is little, if any, access to utilities and infrastructure. The World Bank, as we heard this morning, has been working very closely with the government over the past many years, and especially with a lot of focus over the past year and a half post-revolution on addressing this major challenge. We've also been consulting with various stakeholders, beneficiaries, developers, households, to see what are the main challenges, what is missing from the building blocks. And we've developed, in addition to the first operation, which is mortgage finance project to establish the liquidity facility, we've prepared a development policy loan of 300 million that is to support the program of the affordable mortgage finance. And this basically worked on reforming the subsidies, the housing subsidies, and this is maybe the only subsidies the World Bank have managed to reform in Egypt, as opposed to the different other forms of subsidies that are provided. The program has basically supported reforming the subsidies in that instead of the subsidies, the supply side subsidy, instead of it going to the privileged connected developers that never reach the poor that really deserve them, the program has moved these subsidies to be more demand-side driven, where it would go directly to the beneficiaries, more transparent, more efficient, and well-targeted. In that context, we've also looked at the gender dimension. And we put a lot of effort to do gender mainstreaming in the operation. And despite the fact that the women have contributed and played an instrumental role in the revolution, they have been marginalized and they have not reaped any benefits from the revolution. And there is a lot that needs to be done, and their situation has been deteriorating ever since. As Simon mentioned, we're going to show you very short videos that document the experience of 3 Egyptian women that benefited from the Egyptian Affordable Housing Finance Program that the bank had supported. In these videos, you will hear Sarah, Wafa, and Fatma, who are going to share with you their experience, and they're going to tell you how having access to a house, owning a house, has helped them have security, safety, and stability that they had longed for, and also helped them to start a family and to raise a family too. In their very simple words, their words will speak more eloquently than any World Bank document or bank staff can say. Thank you.
Wafa Mustafa is opening the door to a new life. This apartment in progress is hers at a subsidized rate. She's been renting for years, and the thought of finally owning is wonderful, says the 32-year-old mother of 3.
طبعا هيبقى في حياة استقرار. يعني لسه عايزة توضيب طبعا، أنا لسه هتشطب وعايزة توضيب، وإن شاء الله ننجح فيها على خير.
Wafa was able to purchase her 2-bedroom apartment through the Affordable Mortgage Finance Program, geared toward helping Egypt's low and middle-income families buy homes through targeted and transparent mortgage subsidies. Providing affordable housing is more important than ever in post-revolution Egypt, where approximately 75% of Egypt's newly formed households cannot afford formal sector housing. Fatma Zain Labidin says she'd been engaged 2 years but almost given up on ever finding a Cairo apartment she and her fiancé could afford. Then she learned of the subsidized mortgage program.
قدمت باسمي واللي هو مش مقتنع، يعني مش حاطه في دماغي قوي، يعني ما كنتش متاكده قوي ان انا هقبل او انا هيقولوا لي الشقه موجوده او كده. يعني قدمت وبعديها بشهرين لقيتهم اتصلوا بيا ان اجي اكمل الاجراءات واروح ادفع الفلوس.
The Egyptian Mortgage Finance Fund paid half of the down payment for Fatma's apartment and set her up with a bank that gave her a mortgage that she and her new husband can pay back over 20 years at the equivalent of $67 a month. Under this program, an estimated 1,000 apartments have been purchased since January 2011, 15% of them by women. By mid-2013, the World Bank-supported program will be scaled up to provide up to an additional 40,000 apartments. Sarah Ali spent 2 years drifting with her husband from one rented Cairo apartment to the next, each time the landlord would increase the rent.
كناش هنعمل حاجة إن إحنا ممكن يعني إيه، أولاً عدم استقرار، ما كنتش أفكر إن أنا أساساً أخلف.
But the mortgage program has since helped her with a down payment toward this apartment, where she and her husband finally had a baby.
So I think you'd agree that that's very powerful, and the video is available on YouTube should you want to share it with colleagues or watch it again. Okay, so let's get started with the session. I think the first speaker will be Kasia.
Hello. It's so nice to see you all and to be here with you all. Simon, thank you very much for the invitation. And thank you to the World Bank for doing this so often so we can all see one another again, because we don't get to do that very often. And it's really nice to have this conversation and to hear about the experiences from across the world. I'm going to be talking about new market development in Africa. And I think when we take a look at what are the housing problems? And it really depends if you're talking to financiers or if you're talking to planners. There's a sense of desperation about how do we manage. And there's also a real contradiction because we're seeing across the continent quite astonishing growth. And this has been repeated, certainly in economic circles, quite a lot about the GDP rates in Africa and how significant they are. And certainly off a low base, but still growing very substantially within our current economic climate. That's fairly special. And so we have investors who are beginning to look at the continent, and you would think within that space then housing should just flow. We also have the other ingredient which should make environments work, is that we've got a lot of demand. So in that space you would think that developers would come and want to build lots of houses. We've got massive urbanization, people moving into cities, those cities growing economically and productively, and a real sense of opportunity. So in that space, why that contradiction of those two pictures that I had earlier? And then something that I think Simon has really been at the forefront of pointing out is the relative size of mortgage markets, and that mortgage markets in Africa are very small. South Africa's mortgage market is the largest, and that's at 30%, followed by Namibia, which is at 20%, and then a few North African countries, and then after that it's all below 5%. And within that context, well, what's going on? We've got investment, we've got money coming in, we have urbanization rates and demand and so on, so why can't we get it? Now, you know the answer. We all know the answer. In part, it has to do with the affordability of the consumers. Housing's expensive, and certainly to buy a house with a mortgage product requires a regular income of a particular size that you can imagine will still be there for 20 years. Or maybe even for 10 years, but it requires a long term. And Simon put out in some research that he's been doing over years and started talking about perhaps over the last couple of years, is that only 3% of the population in Africa actually has income sufficient to support a mortgage. Now that may be an income in terms of its quantum, or it could be incomes in terms of their regularity. So there may be the affordability for the mortgage, but the way in which that income comes in doesn't suit a mortgage product. So if it's only 3%, then there's 97% of the population that we need to solve the housing problem for. And that's why we're here. Interesting work coming from the African Development Bank then starts to take a look at how is the rest of that population, the 97%, how do we understand the different income parameters within that? And that's really where I'm going to start looking in the course of this presentation. The other side of the problem, of course, and I'm not going to dwell on this, but just want to put in this slide as a placeholder for all of you to say, yes, we understand that access to serviced land and title in the mortgage context, but even just access to serviced land on which to build, is scarce and difficult for a whole range of reasons in very, very many countries. And there are different levels of competition for best use. So it may be that land is chosen, for instance, in a country like Mauritius, best use of land may well be for tourist purposes. And then access to housing in that context for low-income earners becomes a challenge and pushes the price of land up. That's also the case in my country, in South Africa, and you think of Cape Town, and everybody wants to have a property on the beach. And so access to land in those contexts, there's competition for resources. Also best use in terms of other kinds of uses like retail, commercial, industrial, and so on. And then the challenge of infrastructure investment and how difficult it is to retrofit neighborhoods with solid infrastructure, and the enormity of the backlog, the infrastructure backlog. So we know this, and we can hold on to that, and of course that's part of the solution that we have to start to address, is to piece by piece address these issues. And on the access to finance side, and this is perhaps the subject of many people's presentations over the next 2 days and conversations that we'll have in between, are how do we make the finance side work so that not only are there the loans that can be lent to individuals, but those of course depend on investors of various types being able to put money into those sectors. which means that the investor has to feel confident that there's a return, and I think that was already raised to some degree this morning as well. So how does one make that whole access to finance system work? And again, a problem that we have to address. And because of those challenges, and I'm simplifying things, you have very limited levels of housing supply, formal housing supply, and the scale challenge was raised this morning. What I want to start looking at, though, is that once we've got this and we've established, yes, we've got a lot of challenges, and we don't want to minimize our understanding of that. They're very real challenges. There are specific interventions that can be made on a much more nuanced basis that really offer some opportunities for change and development. And those interventions, which offer, it's a more nuanced approach to what is the housing need and what are the opportunities that we can now start to be promoting. So if we take a look back at this income pyramid again, and on the right-hand side, you've got the data as set out in that African Development Bank report, which was looking at the growing middle class. And they say that about 20%, just under 20% of the population earns over $20 per day, and then just over a third of the population earns less than $2 a day. And so in between that, there's 50% of the population that has some kind of an income that can be used for something. It can't buy a house, because houses are expensive, and it can't buy a house all at once. But there are spaces in which we can start to promote. So what I would like to see in the course of these 2 days is a conversation that says, right, where do we target specific interventions? We would all love that magic bullet, but in fact we probably need a slew of them, and maybe that's a bad analogy at this point. But what we need is to start to look at the specific spaces in which we can intervene and provide different kinds of opportunities. I'm going to raise three and talk about three broadly: bringing mortgages down market, and in part that's about trying to make houses cheaper as well. It's also about extending lenders to better understand markets that are below what they normally service. Secondly, to look quite seriously at growing and developing housing microfinance, and I think that's a serious challenge to absolutely every single lender, not just microlenders, about how to explore the opportunity for incremental housing and housing microfinance. And then thirdly, the opportunity around financing rental housing. And as I speak about these three, what I think we must also bear in mind is that we have to target subsidies very carefully, transparently. We've heard already about and how important that is. And target them in a way, as was mentioned in the previous session, in a way that supports investment of the private sector, so that you get a wider scope and a better gearing of the public and private and household resources to realize the housing ends. So first, to talk about bringing mortgages down market and making houses cheaper, I'm going to talk about the specific example in South Africa, which maybe some of you are familiar with. 1994 in South Africa brought a democratic government and a pretty fabulous housing subsidy program. 60% of the population, at the time it was 20% of the population, households earning less than 3,500 rand per month, which is about, what is that, about $400 per month, eligible to apply for a housing subsidy which would give them a free house, a 40 square meter structure on a 250 square meter plot of land at the time originally. And the government made a promise for scale. They said 1 million houses in 5 years. And remarkably, they managed that in 7 years. And that has been growing. And since then, touch wood, we think, more or less about 3 million houses have been developed. Fabulous. The downside is we still need as many as we thought we needed in 1994, because of course when you're giving free houses, the demand doesn't stop. And the way in which that housing subsidy specifically gets targeted and the kinds of behaviors that it then starts to encourage within the beneficiary population, within government, within the private sector, segmenting out the people getting subsidies, they're sorted. The banks say, people getting subsidies are sorted. I don't need to look at that market because the government's going to deliver to that. So there are a whole lot of issues that have arisen, and it's a worthwhile case study to look at. What also arose from the government-subsidized housing program was that there was a segment of the population that wasn't eligible for subsidy, but suddenly couldn't afford to buy the cheapest house that was being developed. And that we've been calling the gap market, and surprisingly, that's entry-level and blue-collar working-class people. It's key public sector workers, and they've started to march in South Africa. So it's been a critical issue that the government is having to look at and address. So in that space, what happened at the beginning of this year is our President Jacob Zuma announced a triad of subsidy interventions to try and address the gap market. The subsidy market carries on, 60% of our population eligible for that. The gap market now there are 3 interventions. Clearly the government can't afford to subsidize everybody's house, and the big challenge is, where do you draw the line? So what they've done is, first of all, they said they'll introduce a finance-linked subsidy, a subsidy that is only accessible if you also access a mortgage. And then you need to take those 2 together, and you can only use them if you buy a house that is cheaper than 300,000 rand. So that's about $35,000. Right now it's very difficult to build a house for 300,000 rand in South Africa, given land and infrastructure costs, and the entry-level standard that gets created by the subsidy house that's being given away for free. So 300,000 rand is a pretty challenging ceiling to offer, and the government is now offering this through a pilot program. In addition to that, a mortgage guarantee has been offered and is being developed. That's not yet finalized. And that mortgage guarantee is specifically for loans that will be used to buy houses that are less than 300,000 rand. So another pressure coming on, focus on making your house cheaper. And then thirdly, a tax incentive to developers to try and address the making the numbers work to build a house that's less than 300,000 rand. Now, I have to touch wood, because I don't know if it's going to work. It's just been announced. But we hope that it starts to make an interesting intervention, and in the long run, certainly what the government of South Africa needs to do is to relook at its entire subsidy program and how it manages the subsidy and the affordability. But the real shift that's starting to happen, I think that we can all learn from in a variety of contexts, is that it makes a lot of sense to pull together public, private, and household finance and affordability, and pull the 3 of those together to deliver affordable housing. The last intervention that's been also happening more recently in South Africa is a focus on informal settlement upgrading, which is a bit of a hint away from our government-subsidized housing program, the free housing program. And the jury's still out about how it's going to play. There's a lot of policy development underway, but certainly it's a good space to watch if we're all interested in developing a policy and finance approach that respond to the affordability needs in a particular country. Shifting on to looking at housing microfinance, and there was a question about that in the last session. What I think is very interesting here is that we often think about housing microfinance as sort of an add-on, as something that the growth of the microfinance industry got a lot of enthusiasm. The last few years have been a bit rough in microfinance, and housing microfinance is just the word housing in front of microfinance. And in fact, it's quite different. And we're beginning to see some really interesting interventions that are growing beyond an NGO approach that's just about building 1, 2, 3 houses in a settlement, maybe 100, to starting to achieve scale. And a real leader in this is in Angola. Development Workshop has been an NGO that has been working around economic and local development in Angola. And they work around the establishment of a microlender called Kishikredito. And Kishikredito noticed that a significant portion of their borrowers were actually trying to use their loans to invest in housing. And so what they then developed was a housing microfinance loan specifically called Kishikasa, which would support the development of housing on an incremental basis. And this diagram here is showing really just how that's imagined. So you build something that is not your home first. It is not what you imagine is going to be your final product. It's step 1, but you can pay for that as step 1. And then you extend it over time with a range of supports. And what's fascinating about this example is, of course, that finance you can't have finance by itself. You need, in addition to finance, you need to understand a housing process. You need to understand where to put the doors and the plumbing and all of that. And that needs to be somehow facilitated. So what Development Workshop also did is that they formed and they worked with the formation of a company called Habitech, which provides support services of various kinds, plans and advice and so on, to provide households with the support to actually build their housing incrementally, so that it's not a haphazard process, but actually a planned and realistic process that suits their affordability. In addition to that, and this is where we're beginning to see a shift towards scale, from something that was quite a small set of interventions, an experiment, to bigger process, is that Development Workshop is working now with CLIF, which is the community-led infrastructure finance facility funded by Homeless International, to provide infrastructure financing around a development, and to actually use incremental housing not as something that each individual household does, but it becomes a development that grows over time. So we're beginning to see a shift of the whole notion of development, and how do you finance that you can finance it on an incremental basis. Again, another place to watch the space and to see what is the experience. How do you link together the development process for infrastructure financing, and certainly some level of subsidization that comes into that for very low income earners, and then add a construction process that happens incrementally and is financed incrementally in a way that's affordable for households. And we're now beginning to see examples in a number of countries where this is being explored. Another example of starting to go towards scale, and where we begin to see a mix and a connection between an NGO, what has traditionally been an NGO-driven approach, and a commercial lender, is in Malawi, where Select, which is a housing micro-lender, a commercial lender, is partnering with Habitat for Humanity. And Select provides the housing microfinance. They offer it as one of their products. And then Habitat for Humanity provides construction technical assistance, and that cost is covered by Select. Select sees that as a marketing cost, because they feel that they get an enormous amount of reputational strength from the site visits that happen through the construction technical assistance process, and by offering this additional service. And the different kinds of CTA, or construction technical assistance, that Habitat for Humanity offers ranges from basic entry-level technical information, leaflets, sample plans, that kind of thing, through to professional services and training, to get to the point where, in fact, the borrower can make a decision about where they're going to build their house and how that house gets built, so that they don't have to knock it down and restart when they make a mistake. So often we see that people build, and it becomes, in fact, more expensive for low-income builders to build without advice, because they have to knock down the mistakes and start over again. And the construction technical assistance is to address that. That also protects the lender, because a happy homeowner who got a loan from that lender for a house that's standing up, that they don't have to change, is going to be a happy borrower, a happy repayer. One of the things that they're starting to explore is, well, how do we offer this construction technical assistance on a wider scale? And are there particular services that they could offer which would be charged for, and other ones which become part of the loan? And then how do you grow the capacity of an institution like Habitat for Humanity International in Malawi to offer that service to a wider array of households? Right now, apparently, the coverage is about 40% of all loans that Select offers. And so there's a challenge within that space, but it's certainly an interesting connection where you have this commercial lender together with the micro-lender, with Habitat for Humanity. Habitat for Humanity is also working in Malawi with Opportunity International in other settlements within Malawi, and they're working as well providing construction technical assistance in Ghana and Uganda, and they've got plans to extend also into Zambia and Angola. They're working on product development as well in Ghana and Angola around different kinds of housing microloans. So this link of connecting your finance, your incremental finance, with your construction process, I think also starts to deal with some of the insecurity of the financier about what is this housing part that connects to the loan, and helps support the vision process so that you can begin to see that a small investment in a small square meter structure eventually can become a home that everybody is proud of and supports. Okay. So another example around housing microfinance in Kenya has to do with work that Rooftops Canada has done. And they've been working with NACHU, the National Cooperative Housing Union in Kenya, for quite some time, for decades in fact. And the scale has not been huge. It is a solid and strong institution within Kenya, but hasn't delivered to the scale certainly that its membership would require and would want. So in order to try and gear that capacity, Rooftops Canada raised some funding from the Canadian Cooperative Housing Federation and from CEDA. And they used that as a guarantee for NACHU to be able to raise loan funding from the Cooperative Bank of Kenya. And that's an interesting process. They're learning a lot of lessons from that, not all of them good. But the next step, and they'll be better at the next level of negotiation. And what it is, again, is trying to get mainstream lenders to start to recognize the opportunity to be found in incremental housing development. Other investors are also coming into this space. Microbuild, you'll hear later about the new urban finance facility for Africa. And then the community-led infrastructure finance facility that I've spoken about, all showing that there are investors looking for real returns who are starting to put their bets on incremental housing. And I think that's really positive. Those are lessons that we can grow from. The last one, and I'm really almost done, Simon, is the financing of rental housing. And I'm glad there's a session on this today because it's an important area, and certainly in the African context often gets overlooked, the importance of rental housing. And yet people need housing in different stages of their lives in different ways. And in this space, to start looking at the different kinds of niche markets that are undersupplied, and some very interesting work has been done, investments from International Housing Solutions in South Africa into student housing. And a whole new market, who knew? And that's completely regenerated certain areas of our cities. Also looking at the needs of the urban workforce and people who are migrant workers are coming into cities to get employment. Housing for the elderly becomes another opportunity. And then on the other side, that there are different kinds of rental housing. It's not all about tall structures. Backyard rental becomes a really important opportunity to also support income generation opportunities, and there's a planning function that needs to fit into that together with a finance function. And the Trust for Urban Housing Finance, also in Johannesburg and now wider throughout South Africa, has been doing some great work with small-scale landlords who are learning, similar to a shore bank methodology and experience that you've had in the United States, about how to operate and build rental businesses, 1, 2, 3 units at a time. So, thank you very much. I think the thing that we need to take away from all of this is that we can't presume that low-income households do not have affordability. There are different ranges of affordability, and depending on supply, there's different choices of what one would spend one's money on. And I think this is a great example. This is a house in Zambia, and they have satellite television. Maybe they can't find bricks, maybe they can't find a housing option, but they can certainly get TV. So that is a really good challenge to all of us to target, and more specifically target, our products to meet the affordability, which is quite vast, of the population across the region. Thanks so much.
Thank you very much, Kezia. And I think the next presentation follows on almost perfectly on this, looking at the affordability challenge and some of the products that can help bridge that gap. So David Smith from the Affordable Housing Institute.
Thank you all for coming. I particularly want to thank Dr. Mohi Eldin for stealing most of the remarks I was going to make. My name is David Smith. I am, as Simon said, I guess it's good to be called a veteran of affordable housing, because I feel like I should strip my sleeve and show my scars and say these wounds I had in housing's service. Perhaps I'm here because I'm a veteran of 36 years of the finance of existing affordable housing as a banker and investment banker, and haven't gone bankrupt in that entire period of time. Indeed, I started in 1975 when I was told that it was the worst housing and finance market since the Great Depression. And now here we are back in 2012, where I'm again being told it's the worst housing finance market since the Great Depression. But I'm going to be cheerful, because you can't get to this age and be a pioneer and not be cheerful. And what I want to talk about, Dr. Mohaldeen, in his opening remarks, identified 6 pillars. And 3 of them absolutely connect. Part of what makes this a difficult environment, difficult sector, is you have to connect financial instrument, which is an intellectual concept, the entity. He called them robust housing finance institutions. I'm going to broaden it. Call them mission entrepreneurial entities, or just to say it easily, me's, as in it's all about me. You need a party to turn the financial instrument or the guarantee into viable outputs. And the third thing that you need, and it has not enough been said, although it's been implied, Dr. Mohaldeen called it consumers. I call it a value chain with touch, an ability to get to people in the neighborhoods and make credit decisions. Okay? So what we do, we're called the Affordable Housing Institute. I stuck the word institute in there to indicate we do this for the impact, but our model of change is to identify entities who do something in their markets, create a product or a service, a widget that a customer wants to buy. In economic terms, we turn demand into effective demand, and we try to help them go from what they are to what they want to be, which is this mixture of the simultaneity of the DNA, the financial product, and the expression of that in a business organization. We've worked in most of the country shaded in red in Sangeet Ram's presentation. That's a pretty good map for where AHI has worked. We have worked in Turkey with Toki. We have worked in India with Seva. We have worked in Colombia with Col Ceramica. We've worked in Mexico with Cemex. That's why my head is so pointy from banging it against all of these challenges that we face. So, there's really only 6 words that you need to remember from my presentation. And they come in 3 convenient 2-word bites. The first one, underwrite informality. And I'll even say it again. Underwrite informality, because Casey has bottom 97%, and even half of the top 3% in fact are informal, and you don't know it. We tend to close our eyes to it. So consider this. Formal housing built in Bahrain that ceased being formal less than a month after it was built. Why? Because somebody did what Casey was describing. They incrementally improved their house. That house now does not meet the building code. That house might or might not be able to get a mortgage. It has changed, it has improved, but it has shifted from formal to informal. Here's another one. You probably can't read in the upper left-hand corner, but that's a street sign, a hand-painted, owner-created street sign. It says A. Martinez, lot number 2, High Ridge Road, Del Valley, Texas. That is informal housing, completely illegal in the United States of America. Okay? And what you also can't see, probably because you can't read it as it's in script, is it says over there in the little right-hand corner, follow the yellow brick road to Oz. For those of you who remember, Oz is the city that you go to for your dreams to come true. And I put this up here because this is an example. This house will never go away. And one day it will get formalized. So here's the next question. Is that formal or informal housing? Now this is a trick question, because at 9 o'clock in the morning when we first arrived at that site in Durban, that was informal housing. And at 2 o'clock in the afternoon when we left that site in Durban, it was formal housing. And what happened between 9 a.m. and 2 p.m.? The people of the community, under an agreement with the city of Durban, conducted an enumeration, which is like a people's census. And the people filled out, you can't see the particulars, a form on which they listed the size of the house, the dimensions, they hand drew a map, they listed who lived there, what they earned, and so on and so forth. And under the agreement with the city of Durban, that information then became real by going into the cadastre and going into the electronic system, and that house, however illegally built, however questionable its zoning, was formalized. And that's the first part of this message, is that you are dealing with housing that will start informal and become formal because everyone involved wants it to become formal. Even, by the way, municipal government. Because there comes a point where these are too big, too prevalent to ignore, and yet they're part of the economy. Because the other thing, anybody here, please open up your wallet, take out a piece of paper called your local currency. What I want you to understand is that this is the boundary, this is the translator between the formal and the informal world. You may have people who work informally, they earn formal money. Their money contributes to the formal economy. Part of the reason you have housing demand go up is because those people are making your society work. In Ahmedabad, India, something like 60% of the GDP of Ahmedabad is in informal labor. And part of the reason that it's hard for formal developers to go down market is because they can't see it because it's not electronic. But that it is not electronic does not make it unreal. So here's an example. This is from Ahmedabad, and I will do this quickly because you understand this story. Informally employed person living illegally in a house. House could not be made legal because of archaic laws that come from the time of India's independence. Okay? Would take too much money to fix. She's a home-based worker. Many informally employed people are home-based workers. Many of them are women. She spins thread for a living. She took microfinance loans. They were too small to fix up the house. But in stages, she built a front porch so the kids could be back there and she could work in the front. She tiled the floor with her own money. She plastered her walls. Those things improved the quality of her house. They also changed her workspace. And her income tripled. And the tripling of income can be reflected by the fact that there was an increased amount of cash money she was putting in the bank from her activities. So she created a credit history. So that's the first thing. You want to underwrite informality. Now, second thing, second basic idea. You want to underwrite durability, and you want to do it with a product that we call home asset loan finance. We call it that because it acronyms to HAF. Because it's not microfinance and it's not mortgage finance. This is a variation of Casey's chart, and it's abstract, so just treat it as balloons. On the upper right, we have lots of banks. In every one of the countries relevant to this discussion, there are lots of banks who have lots of money chasing a relatively small demand for traditional mortgages. So there's lots of competition for Casey's 3%. At the other end, we have tons of demand for microfinance, and only a very small number of MFIs who can satisfy it. And there's a whole series of reasons which we needn't get into as to why it's hard for the MFIs to grow. But there's this space in between where what you want to do is improve the house. Casey's Kishi Credito physical example is a perfect example. Okay? You want to improve the house, and that takes a larger loan than an MFI can provide, and so you have to do something else. What you have to do, and by the way, everywhere you go in the world, this is the problem you encounter. It is not mortgage finance. Okay? There's no formal title. It will not beat the building codes. It's going to be a small loan. It's going to be questionable as to whether you can repossess the collateral. You're going to need a high interest rate for all sorts of reasons. It's not mortgage finance. You take this market to a mortgage lender, and they say, my goodness gracious, this is a small, short-term loan with rickety security. The picture down below there, the little visual image, is the smallest human-powered airplane in the world. It's the Gossamer Condor. If you asked aircraft designers to design a small flying object, that's the smallest they can get. They would say you cannot take mortgage finance down market. It's not microfinance either. It's too big a loan. The tenor is too long. It does not finance income generation, which is the mantra of microfinance. It's unclear how the borrower is going to pay it. You have to believe the borrower is going to make more money. So to a microfinancier, this looks like a really big loan over a really long time to somebody you don't know very well. Neither mortgage finance nor microfinance will grow to the other thing. So what you have to do, like you're drawing your graph, loan tenor on the horizontal axis, loan amount on the vertical axis, there's microfinance. I can't get across the gap of building the house with microfinance. I have to borrow more money, which means I have to have a longer loan tenor, which means my credit decision is now quite a bit different, which means, and here's the point, I have to underwrite the asset. And that's the second two-word phrase. Underwrite durability. Because what distinguishes real estate from every other asset class relevant to this discussion is the one that's so obvious we forget it. You can't move it. And because you can't move it, if someone takes money and puts it into a house and you want to go see whether they spent it on the house, you can see that. And if you want to go to try to collect against them, you can see that. If they decamp, the house stays behind. People don't want to do that. Okay? So, to make a house a good candidate for half, we're looking for durability. The first thing is physical durability. Something that is structurally well built enough to survive the monsoon, survive the tsunami, be improvable. It has to hold its value over time. Second, it has to demonstrate occupancy or use value. I'm going to explain the picture in a second. If you see people transacting with cash for the right to occupy housing, that's an indicator of durability. The third one is longevity of tenure. Col Ceramica was cited earlier. One of the challenges of underwriting in Colombia is that we had these nasty group of people called the FARC who every now and then would go into town and burn down City Hall, and that would destroy all the records. So I had a house that was formal and then it became informal. So Colombia created a testimony thing. So if I and Casey said that Simon had lived in his house for 3 years, and we gave affidavits to that effect, but he didn't have title because City Hall got blown up, he could get a new formal title, okay? So longevity of tenure turns out to be one of the things that makes formality. And the last one is city services. I loved Dr. Mohieldine's discussion this morning about the necessity for delivering mail and getting into the civic system. So the picture that you see there is from Sao Paulo. It's from the Singapore project in Sao Paulo that I went to see. And it says, house for sale, okay? And it has a street number and a mailing address, and has security on a door. And as you can see, it's made of cement block and cement. So there's physical durability, there's a connection to city services by inference, strong inference, there's occupancy and use value. This is the sort of thing that we would like to lend on, or we would like to have a client lend on. I don't really have time to go through all of the details, but basically in between the $500 half a year microfinance loan and the $10,000 10-year mortgage loan, the only one I want to call your attention to is the banker's business of the risk features. Because the nature of the risk changes diametrically. In microfinance, if you go into default, loss given default is 100%. So don't go into a default. In asset-based finance, loss given default is less than 100%. So you can change your dynamics, okay? That means, by the way, and I don't have time, it means you change your valuation and your value chain and your origination chain, or your origination sequence. And so here's my third two-word message for you. Okay, what we are about, what AHI is about, what I hope the World Bank and you all are about, is formalizing informality in the urban environment. I do not know of a global city, a great city of the world, that did not at some point in its history find a way to formalize what had heretofore been informal slum neighborhoods. Every one that I've ever been able to investigate, including London in the late 18th and 19th, New York in the middle of the 19th and early 20th, formalized informality. They held their nose. They found a way for people to earn their way into the system. Okay? You want to formalize informality. And so what that means is, don't try to take microfinance and make the insect bigger. That's the biggest insect that can fly. It's about yay big. Don't take mortgage finance and try to make it smaller. That's the smallest airplane that can carry a person, and it's only that small. So you have to create something that's halfway between an insect and an airplane. And by the time you discover it, it was there right in front of you all the time. It's a very simple thing to understand, and it suddenly gets easier. So summarizing, and I'm going to describe these little boys for you. There are three sets of two words: underwrite informality, underwrite durability, formalize informality. Because the desire to invest in a better home is universal. Those little boys were wandering around in the playground of a Singapore project we went to in an informal neighborhood in Sao Paulo. And the translator said, "What are you doing?" And they said, in the manner of 7-year-old boys everywhere, "We're building a house." Tap that, and you can make successful and profitable business. And if you invite me back here in 2 years, I will be able to show you the track record and case studies, because we are investing in that now. Thank you very much.
Thank you very much, David. Consider yourself invited back. So I think that the next presentation is also very interesting, from a country that's had a lot of success in deepening its access to housing finance. And it will come from a different angle, so looking at the role that the governments can play and the public sector can play in deepening inclusion in housing finance.
Okay, thank you. Well, good morning, everybody. I would like first to thank the World Bank for giving me this opportunity to listen to different experiences and share our experience. And special thanks to Simon for inviting me to this conference. I will try to present, in this presentation, I will try to give you an overview of the affordable housing finance in Morocco. So I will speak about a lot of aspects. Demand subsidies, offer subsidies, but I will particularly have a focus on an experience which is a guarantee scheme for informal income households, which is called Fogarim, and is effective since late 2004. So my presentation will be in 3 parts. I will begin with the quick background about Morocco, just to focus maybe on 2 or 3 main important points. The first one, well, the factors driving the demand in Morocco are, as they are in other countries of the region and in the world. There is a shortage estimated in Morocco to 500,000 houses. It was 5 years ago, it was something like 800,000 houses. So it's going down, but it's still there. There is also new households which are created each year, 150,000 new households, given the demographic characteristics in Morocco. You know, we have a young population, but also given the urbanization, the quick urbanization of the country. There is also a demand which rises from the increased income. You know, when the condition of the population are improving, there is a new demand which was not there before, because they didn't have enough income to buy houses, but there is new demand. So that is somehow a global picture about the factors driving the demand. I will go to, in the presentation, I will speak about what the government did just to bring a sufficient offer to fit with that demand. 2 other things may be very important for us. First one is that Morocco have experiences, let's say, good growth during the last 5 years. It's something like about 5%. But mainly it's important to stress that it was achieved in stable macroeconomic framework, low inflation rate. The median inflation rate over the last 16 years was above, around 2%, which is very important because it's structural rational to build a comprehensive mortgage finance system. The second one is that Morocco also had managed to develop That's some kind of strong, on a local basis. I'm not talking on an international basis, but we have, let's say, a financial sector which is strong. With just one number, the total assets of the financial sector is something like 200% of GDP. For the banking sector, it's 130%. We have also a well, let's say, supervised and regulated financial sector, which have not come through, let's say, a big impact of the crisis we have seen during the last years. That is very important to have these two features: a stable macroeconomic framework and solid or a strong financial sector, because our role as government, as public authorities, is to develop a sound financial sectors that allow to finance housing on a market basis, so that after the role of the government is just to come with initiatives to address the inefficiency of the market. And the inefficiency of the market, we can see it, for instance, in financing informal households. So that's for the background. Now, if we talk about what are the initiatives in Morocco for affordable housing, I will speak about on three parts. The first one is how to produce affordable housing. I think that's the main first question. Let me first just describe what is affordable housing in Morocco. We have two kinds of products. One called social housing, which with a cost which is less than $30,000, and the other one is called the very low cost houses. So this is a program for houses, built-in houses, very low-cost houses of $17,000. It is notably used for slum households. That is not, let's say, a product which is used on a global scale. It's used for a specific program, which is the program we call in Morocco Cities Without Slums, a program for over 300,000 households, which is financed notably through a tax on cement. For these products, we have incentives on the supply side. I think our colleague from McKinsey this morning talked about this PPP. So one of the features to have private real estate developers build social housing is that we provide incentives, tax incentives, but we also provide public land at competitive cost for private real estate developers with conditions. They must produce a certain share of affordable housing. And there is also a big tax incentive in which we say that for this social housing, there is no income tax on revenue generated by the real developers, the real estate developers. There is no income tax on income generated by this activity, not on their total income, but only income generated through building social housing and through selling social housing to the targeted households. So this program is new. There was a previous one. It had been amended in 2010, and since 2011, agreements have been signed with real estate developers to build something like over 1 million. Now it's over. It was almost before I came, before when I sent the presentation. Now it's over 1 million social units over the next 5 years. That is on the supply side incentive. So it's good to produce social housing, but I think the most important is how to finance the targeted households to buy the social houses that were built. So we have two kinds of incentives. The first one, let's say, it's tax incentive for mini residents, which is deduction of interest payment of mortgage loans from income tax, and also value-added tax exemption on social houses. but with condition to occupy the house for at least 4 years. This is on the tax incentive side. On the let's say direct subsidy side, we had a program before 2005. I will speak about this program just to link to the Fugarim program. Before 2005, we had some kind of interest buy-down system. It's interest subsidies. We were subsidizing interest. So the main aim of this program was to lessen the cost of financing. It was a program which was put in place in the 80s, so it's a very long program. It was run over almost 30 years. This program, maybe in the 80s and 90s, this program had some good features, but when we analyze how it works, what the system showed is that regarding targeting, when you are subsidizing interest, that's mainly medium income, and that's mainly formal income that are benefiting from the program. They have the capacity. The banks are more want to finance them more. So regarding targeting, we see that mainly these are medium income that benefits. It's a high cost. Subsidize a loan, 20 to 25 years loan. Interest on the loan, is a high cost, and it's also complex to manage. There is also a weak marginal impact of such program. And on the other hand, that's why I speak in the background about the macroeconomic stability, because this macroeconomic stability permits to a large decline in interest rates. So the subsidizing interest, maybe it's better to work on the structural reforms that allows interest rates to go down, and then try to find solutions for those who cannot access to finance. And those are households with we call in Morocco irregular and low income, which means informal income, which means people who are not having salaries and social security. So given this analysis of the previous program, in late 2004 we put in place this initiative which is called Fugarim. Fugarim is simply a name for Fond de Garantie. So it's a guarantee fund for irregular and modest and low income. Simply, it's mortgage insurance fund. So the objective of Fugarim is to encourage banks, so it's something like downscaling, to encourage banks to finance low and irregular income by securing their loans against credit risk. Targeting, so the first condition is not to have formal revenues. So we check that the beneficiary should not be a civil servant, should not have social security number. So to benefit from the program, you need to have informal income. For the low income, it's very difficult to estimate the income of informal social houses. So what we do to target the low income is through the price of the house, social houses. So the house should be social house, like I described before, and also through the monthly payment that will be done on the loan, which should not exceed a certain amount. Not to be homeowner, that's obvious. And certainly to practice an activity that generates income. It's not enough to be just to have low income, but it's important to have an activity that generates income that can be estimated by the banks. So the parameters of Fugarim, very quickly, the guarantee is 70% of the loan. Only fixed interest rate, because this population cannot understand floating rates. For the fund equity, the guarantee commitment are limited to 8 times the fund equity, which means that at the end of the process, the non-performing loan should not exceed 12.5%. and there is a life insurance and mortgage security on the house. Very important feature maybe, that's the premium fee. That is correlated to the LTV, loan to value. So the premium is higher when you have a loan to value, a higher loan to value. The important thing is that this premium fee was only put in place in 2009. The program begins in 2004, and the premium was put in place in 2009. So from 2004 to 2009, we had a public guarantee, 70%, which is a large share of guarantee, which was free of charge. So but even though the production in the first years was not that high, that's what I would call a positive externality. You know, when you're putting a program to let banks, to bring banks financing this category, you need not to be very sophisticated on the financial parameters. You need to bring these banks to this segment, to tell them that they could do business with this segment, and it's easy to do it. And then when they are there, when they are doing business, and they are watching the results, then after you could, by monitoring the system, implement different kind of financial parameters, like a premium fee, like bringing down the guarantee share. So the management of Fogarim is through two processes. We have an operational manager, which is a public institution under the supervision of the central bank. So this public institution is a non-bank financial institution which is managing the system. And for the strategic decision, we have steering committee, which is headed by the Ministry of Finance, but in which we have a representative of the Ministry of Housing, but as well of the banks and real estate developers. Those are some key figures of Fogarim. So you see how when it begins, when it was free of charge, we had something like, this is the number of beneficiaries, monthly number of beneficiaries. We had very few beneficiaries, and then after the program goes up and we reach something like 106,000 to 108,000 beneficiaries each month. It slows down because of the offer, because in 2008, 2009, that's why I speak about new program launched in 2010, because in 2008 and 2009 in Morocco, the production of social houses went down something like 30%, and we see this on the Fogarim side. So currently there are above 80,000 beneficiaries of the program, and something like 102,000 each month, that are benefiting from the program. The outstanding guarantees is $1.3 billion. Those are some financial characteristics of the Fogarim loans, if we may call them like that. So you see that the interest rate is around 6%. It's something like it's almost the medium interest rate applied on a market basis in Morocco. Somewhere less than this medium interest rate. The loan to value is currently around 75%, and the duration, the medium duration of the loans are around 21 years. Let's go to a very important feature, which is the default rate, because when you are addressing informal households, you expect a large default rate. If you see the graphs above, the first one shows the cumulative default rate, so non-performing loans over 6 years. So we can watch a full generation. That's the maximum data we have till now. But you see that it goes up during the first, that's for Fogarim globally. It goes up during the first 3 to 4 years, and then it begins stabilizing about the sixth year. The graph on the right shows how the average, the average annual default year, how it goes up in the second year and then begins going down. So that means that we expect that at the end of the process, we will be at a total non-performing loans of around 6%. In the graphs below, those also are very important. That's the difference. That's globally, Fogarim globally. The graphs you have down are the distinction between Fogarim for informal or informal households and Fogarim for the specific cities without slums program. And you see how the dynamics are similar, but the non-performing loans is higher than for this program because we have some contagion between, those are projects very difficult to manage. Well, globally what I would say about that is that if we can manage to, through a risk of 6% maybe it's high for bank, but with the guarantee it's something that we could manage. If with something like 6% default rate, we could manage to fund 100% guarantees, that's something that for us, when we compare to the cost of the interest buy-down system, is very competitive. So the cost for the government is very low. So I will go quickly. I have just two additional slides. This one is about funding because it's important to produce houses to allow the households, targeted households, to buy these houses. But it's also very important to have in the market funding instruments that allows the banks to have long-term funding. So we have a securitization law which is underused with something like $500 million issuance, and we are now working on a new covered bond act. It's finalized. It's now in the process of being adopted. So this covered bond, I know most of you know about the covered bond instrument, so I will not go in detail about this. There are also other sources of financing. We have new housing contractual savings scheme, which is effective since April. So I don't have the data now. Since April 2012, it's 3-year minimum saving and no tax on earned interest. And we have also other projects like the real estate mutual fund project. So as a conclusion, just to finalize, maybe 2 or 3 main challenges. The first one on the supply side. You have seen that we have a lot of incentives. I think it's very important to have the conclusion we are in Morocco now is that very important to have an integrated policy for housing which take into account activity zones like public equipment but also employment. It's very important. That's something we always have in mind when we are doing social housing. But social housing is some kind for government. It's an emergency, let's say, activity. So the objective of producing social houses is a priority to the objective of having public equipment and employment. But now it's very important that these two main features should be taken into account when we are planning the program. It's also important to have medium-class households products. Very important, because when you do not have this with some kind of subsidies, but when you do not have this, what we observe is that this medium class, the low medium class, go and compete with the social, with the informal housing in acquiring social houses, because they do not have a specific product and the prices of the market are very high compared to social houses. It's very important also to go from national to local strategy. I've shown you the figures, 1 million houses to produce. That's good. That it seems that it will cover the shortage, but it's more important to check the adequacy between the demand and the offer at the local level, not only on the large number. On the Fogarim side, and I will finish by this. We are looking very carefully on Fogarim for cities without slum. VSB is cities without slum. Fogarim VSB, because we have noticed that there are some moral hazard on the risk. We have some programs in which we have a high risk because people are not able to pay, but do not want to pay because of other problems, because of public equipment which is not available, although it has nothing to do with the bank and things like that. So we are looking at this, and we are also working on new risk-sharing parameters, moving toward portfolio approach and better modulation of the risk. We have some ideas about this. I may answer if you have any specific questions about that. And the objective at the end of the process is to move the system to a mortgage credit insurance institution. Actually, it's only a fund. So thank you very much, and sorry for being late.